Ticker TV. This is Ashi Singh, and today we have a very special guest, Ms. Kanika Pasricha, Director Economist from Standard Chartered. Hello ma'am, Ticker TV wishes you a very happy new year.
So wishing the viewers of Ticker TV a Merry Christmas and a very happy and prosperous New Year.
Ma'am, how does 2020 look like? In the given slowdown, do you see any growth revival in 2020?
So of course we also see growth revival in 2020. That's in line with what the RBI led Monetary Policy Committee and the markets are expecting. But the pace of recovery actually is contingent on 2 to 3 important factors here. See, we are witnessing a demand-led slowdown. So pace of revival in consumer demand becomes very important. A. B. What's happening in terms of resolution of financial sector issues, NBFCs and banks combined. And C. Third important point is what is the pace of recovery in global growth. We're expecting stabilization in global growth. Any risks to that view also become a part of the overall story. Now, what's our core view? Our core view is that, for this financial year, current financial year, growth is expected to be at 5.3% with downside risks. RBI is already at 5%. And next year, we're expecting recovery to 6.3%. The factors driving it is basically in a slowing global world. The key factor driving is first, some stabilization in global momentum because of easing US-China trade tensions. Brexit worries have receded, though recently markets have again started to worry about hard Brexit, but overall Brexit worries have eased, at least for now in our view. Second factor is impact of policy stimulus measures, both fiscal and monetary, 135 basis points of repo rate cut plus fiscal measures, sector specific measures taken, especially the corporate tax cut, though it's likely to be a medium term positive. Third factor is that we're expecting rural demand to recover. The crop returns are likely to improve this year. It's in line with the food inflation spike trend that we have witnessed in recent months. So that is expected to enhance rural incomes and hence rural demand. And last factor is more statistical, a favorable base effect. But what becomes very important to understand is that we're expecting a gradual pace of recovery, not a V but a U-shaped recovery. The reason being that financial sector still remains, it's taking time for the sector to heal. Plus policy levers to stimulate growth are also limited. Fiscal policy stimulus, the space for that stimulus remains limited in our view, given that fiscal overhang is there. So broadly in our view, we are expecting recovery, but pace of recovery to be gradual because of various factors. And of course there's been a realization now in recent quarters that it's difficult, that there's been a downward a decline in growth expectations for India. 4 quarters back we were expecting growth to come back to 7%. Now we are expecting a recovery but back to 6 to 6.5% threshold. So that downward decline in growth expectation is another important factor to note from a global investor point of view as well.
What measures should the government undertake to contain fiscal deficit, and do you believe that there should be given a sort of slippage to support the growth?
So what our view is that this year, given that the government has undertaken some fiscal stimulus on the supply side via corporate tax cut, plus there's been a growth slowdown, so the government will find it very difficult to meet 3.3% fiscal deficit target from the centre's viewpoint. So our view is that slippage would happen to close to 3.8%. They will make use of that entire 0.5% of GDP escape clause under the FRBM Act. Now, improvement of fiscal dynamics is contingent upon 2 to 3 factors, like there can be increased disinvestments, more asset monetization, more expenditure rationalization. But at the current juncture, when growth is slowing, is there space to stimulate growth? If in line with global trends, the government could make use of the, even some fiscal space, or could let fiscal slip. And there's been a talk of implementation of measures like demand side stimulus via an income tax cut in the budget. We think that's okay. The government can do that because India is witnessing a demand led slowdown after a very long time. In fact, for the first time in many years, in many decades, so to say. We were always a supply constrained economy. Now demand side worries have cropped up. But what becomes very important is that even an income tax cut in an economy which is slowing, income growth is coming down, and there's been this job related worry. Unemployment rate is at 45-year high. Even that stimulus measure may have just a short term impact. So short term stimulus needs to be backed with structural reforms to ensure sustained pickup in incomes, jobs and investment, and overall growth in the macroeconomy. What are those structural reforms we think are important? First is that you have to talk about labor and land reforms. The government is working at labor reforms. The progress has been slow, so that could be stepped up. That's first. Then more importantly, health and education is very important. That sector needs to be propped up in order to enhance the health and skills of a young workforce. Then sector specific measures to boost manufacturing and capex recovery, for which one very important factor that comes in is strengthening and consolidation of financial sector, both banks and NBFCs. And last, one good thing about this government is that touch points have been correct in the short term, but better execution of already announced measures is also going to be very important. So in our view, if the structural reforms are implemented and the rating agencies can also see a sustained pickup, even though gradual of growth momentum, rating related issues would not come up. So focus needs to be on policy reforms. A combination of short term and long term needs to be focused upon is very important.
Though the economy remains fragile, Indian indices are hitting new highs despite no major reforms have been announced. What is your take on the same, ma'am?
See, we think that stock market boom. While we are not experts on, we don't have an equity research arm, and we're not experts on equity related views. But what our core view is that liquidity is likely to stay abundant given that global central banks continue to expand balance sheet or want to limit contraction of the balance sheet, starting from Fed, ECB, BOJ. So in this kind of an environment where advanced economies are also slowing down, and maybe slowing down more than emerging economies, you will always see liquidity chasing assets, and equity is one of them, which is why you have seen equity increase, equity prices rise despite fundamentals not improving as much. So our view is it's mainly liquidity, easy liquidity, loose liquidity chasing assets. But for sustained pickup in even equity prices, it needs to be eventually backed by fundamental improvement in macroeconomy.
What are your views on the RBI policy stance in 2020? Do you see more rate easing in the upcoming year, and if yes, then by how much and why?
When in December the RBI paused, and it caught all the economists by surprise as well, and we included. See, the thing is that we were all focused on growth, while the RBI got back to its inflation targeting mandate of 4%. And inflation, given the recent food price spike led by vegetables, which is not likely to correct very quickly. It maybe starts from mid-January, but eventually prices cool off, or the correction gets completed, especially in onion prices, only by end of February or middle of March. So in this kind of an environment, we expect inflation to stay elevated above 4%. Maybe the next reading is above 6.5 as well, at least till March, which is in line with the MPC's projections. So getting back to the inflation mandate is one area, and second is that the MPC is also concerned that they have already taken a range of monetary policy stimulus measures A. The government has taken some fiscal stimulus measures B. It's time to wait and watch to look at the impact of these measures on growth, transmission of monetary policy rate cuts, and also to look at what the government does in the budget in February. So we think that there is still space for rate cuts, given that growth is expected to stay subdued with only a gradual recovery likely. The MPC also expects growth to recover to 6.1% in H1 FY21 from 5% in FY20. And mind you, this 6.1% for H1 FY21 is similar to their FY20 growth forecast before the December policy meeting, after which it was revised downward. So they're clear that growth expectations have come down sharply. Maybe they want to wait and watch for more transmission of rate cuts, and also they want to wait and watch for the budget, plus when the inflation levels start to show sign of cooling off. That is likely to happen only by H1 FY20, in line with their forecast as well, expecting 3.8 to 4.4% inflation in H1 FY21. From that standpoint, we also expect rate cuts to be delayed to H1 FY21, probably starting June. In February, even though they will have clarity on the budget, on inflation numbers, the clarity of or an initiation of cooling of inflation will come with a lag. So in this kind of an environment, rate cuts starting June, we are expecting terminal repo rate of 4.75%, another 40 basis points rate cut, though delayed.
And what is your outlook for bonds in the year 2020? Where do you see the 10-year yield by March end in the first quarter of fiscal year 21?
So, first is what's our published view and what are the risks to the view. The published view that was published some time back was of 6.4% on the 10-year in March 2020. It's staying close to these levels in June as well. But there are a lot of risks to this view now, because first, monetary policy easing itself has been delayed as inflation worries have cropped up. So, even though inflation is likely to cool off, food inflation spike will cool off with a lag. Second is markets are worried about the fiscal overhang. So, what is the extent of additional borrowing that they undertake, that the government undertakes in FY20 in order to, meet the fiscal deficit, in order to cater to the fiscal slippage? What is the extent of operation twist and new monetary policy operation that has been initiated by the RBI to help flatten the yield curve, that has been initiated recently? It has led to sharp flattening of the yield curve, but the momentum can continue only if they announce more of such twist operations in the coming weeks. That will help build market confidence in this regard. So the quantum of the follow-up on operation twist also becomes important. The third factor is what happens in the budget. What is the target? What is the extent of slippage that the government faces in FY20? What is the target fiscal deficit plus borrowing FY21? And lastly, what happens in February monetary policy meeting? So a lot of factors that will play up in this view, and that needs to be watched out for. But fundamentally, in an economy where of course there's subdued growth, we're expecting rate cuts, there should be a positive outlook on Indian government bonds, which we maintain. The levels need to be watched out for, because that become a function of various factors and risks involved.
Thank you so much, ma'am. It was great having you here. We wish a very happy new year to all the Ticker TV viewers. For more details, keep watching Ticker TV. Thank you.